Have you heard of Reunion Resort in Orlando? God, that's close.
I have heard of it, but educate me. I don't know what's the pitch.
So I don't really know what it is. It's in Orlando. Ultimately, it's like a gated community, nice homes, golf resorty type thing. So here's a shameless plug. Legal Services, the event that we're hosting for them October 11th. Be there, be square, because we will be auctioning it off. Actually, no, in the silent auction, there will be a 2 night stay at what is, I don't want to say mansion, but it's a real big house in Reunion Resort for two
Hmm.
nights, and it's going to be way below what you're supposed to pay for it. So that's where it is, and it's beautiful.
Okay. Okay. I hope it comes with at least two boxes of golf balls because that's my average per, like weekend golfing in terms of lost balls.
Yeah, that's reasonable. I would lose all of those.
Yeah.
Um,
Yeah. One per hole.
did you end up playing with Austin at this place?
At the Breakers?
Yeah,
No, regrettably I canceled because I really was excited to play that. I I played Devoted Father. My son's soccer team was in a tournament that weekend and they made the final, which was that morning. And it was like at 11. We were going to tee off at like 8 or 9 and I wouldn't have made it back. So I opted to be the doting father that attended
wow.
the final.
You heard it here
Yeah.
first, ladies and gentlemen. Listener, devoted father, Lane Jones. Thank you for being with us today.
I happen to enjoy children's soccer. Some people follow the Grateful Dead. I follow, 15-year-old soccer teams, my daughter and my son, like
Perfect. It's so
sort of an
perfect.
odd groupie.
It's so perfect. All right, soccer dad, let's do this thing. Welcome to episode 43 of Talk Your Chart. A very exciting episode. As you will notice, today we have a guest co-host and our very own Chief Investment Officer, Lane Jones. Lane, thank you for filling in for the absentee Brett Horowitz.
I will endeavor to do my finest because these are big shoes to fill. So thank you
Yeah,
for the invitation.
game on. I know Brett's nervous to see how the ratings come back. We'll see if we ever see Brett again. Who knows? Um,
It's like you bring Mr. T in on a spin-off of Different Strokes, and suddenly, you get one of those weird episodes where it just jumps off the charts. Who knows?
you brought up different strokes, so that's a point. That's a point for you. Let's jump right in. Concentration, Jonesy. That's my first set of charts here. As usual, I constantly break the one chart rule, and I actually have three charts to illustrate this point. I think it's been a pretty talked about headline this year. At a certain point, it was up about 17%. The S&P was now at about 12. But if you look at it, if you break down that S&P 500 into what this first chart is showing, which is the S&P 7 and the S&P 493, you see exactly that idea of concentration, where that S&P 7 is up more than 50%, and that 493 is basically flat. Is
Mhm.
concentration weird? No, it's not. It's kind of just a byproduct of what is a capitalization weighted market index. The next chart
Yep.
here is showing in the green bars that naturally top heavy index. Yes, we are looking at 34% now as opposed to kind of mid to low 20s in recent past. But I think the important part to point out here is markets don't break because of concentration. Maybe that's a symptom of certain things, but that's not the straw on the camel's back or the underlying factor that causes things to break. And in the last chart, before I let you tell me how you feel about it, is positive skew. The super fancy statistical word for a lot of things happen on the right side of the chart as it comes to the stock market. Why? Because companies can go up way more than 100%, whereas they can only lose 100%. So this is
Mhm.
what makes it really hard about stock picking, because that whole adage of don't try to look for the needle or pick the needle, just buy the haystack. The reason is because most of the constituents in any index underperform the average. Why? Because of positive skew. So that's my
Yeah.
take, and I'm sticking to it.
Yeah, agreed. And if you think about the idea that the bigger a stock becomes, the greater its weight. That is reinforcing, right? And similarly to the other side, which is that the stocks that are doing poorly get less weight, and therefore they have less impact, right? So, I think in the chart about the top 10, I mean, I definitely think that it has gotten bigger, quite a bit bigger. It's a third of the market versus where 20%, and there's a lot of current reasons for that, which is that the tech bellwethers have literally grown earnings at 10-20% compounded, and that's what happens
Exactly.
when
Yeah.
so wonderful that you own those stocks in the greatest proportion. Whether or not that earnings growth is possible into the future is obviously what's difficult to know. um
I think it's important to highlight though, like these companies make a ton of money. They're not
Yes.
making a ton of money. So they're waiting, whether you think it's right or not, the numbers would tell you innovation gets rewarded, and that's what happens.
Yeah, historically, and we maybe talk about this a little bit, the valuation of the average, growth stock is typically overpriced because not everyone becomes a unicorn, becomes an Amazon, becomes a Google. That's not what you're buying when you're buying the S&P 500. You're buying established, businesses with incredible economic moats and leadership and cheap capital, like they've got everything at their fingertips. Um, so yeah, they also have had a confluence of things that have worked in their favor in terms of the COVID trade. They're almost like a defensive stock. It's almost blasphemous to call tech stocks, defensive,
But you
but
said it.
that this isn't just the boom bust innovators of the world. In fact, the Googles go out and buy the innovators, so they're sort of like these incubators for future growth. But you don't have the option to stop using Microsoft tools or buying hardware in the modern environment. So in a weird way, they're somewhat defensive, because of the consistency of the earnings. I mean, they've got a lot of things going for them. So
Yep.
while this is an anomaly, we could even look at this data a little bit and say, what does it say? There's a little bit of a rebound trade in there, which is that the top stocks, the tech stocks, a lot came off of them in 2022. So to some degree, there's some rebound in 2023. But then probably the biggest, wind at their sails is the idea of the AI trade, right? The AI trade has ballooned the tech stocks in a pretty rapid fashion, while the rest of the real economy perhaps is struggling with the idea of rate hikes and recession and banking crises and all these other things that seem to be immune to the tech world.
That race continues. Amazon just invested their fair share at 4 billion into Anthropic. So there you go. Innovation will get
Right.
rewarded until it isn't. So you have a valuation chart up here. Walk us through it.
Yeah, look, for my first, perhaps only appearance here on Talking Charts, I wanted to bring the big game, the cannons. I'm not giving you an indie film chart here. I'm coming in with a Hollywood blockbuster, and that's going to be Valuation. And we'll see some of maybe the rest of the summer movies here. Look, I think when I think about markets, I always start with the idea of valuation. And, this is a chart that sort of diagrams, how valuation varies. You get a COVID and it falls off a cliff. You get a financial crisis, it falls off a cliff. And, the earnings in the market decline. And so therefore, you get these readjustments. The average over 25 years is about 17 times earnings. We sit a little high right now. We sit about 18 times earnings.
Okay.
So my point here is, you came out of COVID end of 21 and you were at way up above a standard deviation, which would be sort of maybe a benchmark for where you might think, wow, we're really rich versus just kind of rich. But so we're sitting at 18 times on a historical of 17, and then you say to yourself, all right, we're a little rich right now, but not like crazy. One of the interesting things, if going on to the next chart here, is sort of to make the point that you were making earlier. The top 7 stocks, top 10, whatever you look at, is that there is this valuation dispersion. The top 20% of the 20% level in terms of valuation versus the bottom percent, and you can see the median stock, right? The average stock in the S&P is maybe a hair expensive. It's at 16 times, 16.9, 17 versus 16.
Okay.
So maybe a little elevated. But if you look at this difference between the most expensive stocks and the cheapest stocks, it's really wide, right? Like that spread is normally about 11, 12 times. And right now it's at almost like 14, 15. So what does that portend? Perhaps it says, wow, the growthy, expensive parts of the market are really expensive, and the cheap parts of the market are really cheap. And what we have historically seen is that tends to rebound. It snaps back. You saw it at the end of 2021. You saw it when you got a vaccine on COVID, and you had a big value cyclical rally. And I think this is just a really telling sign about that value growth dispersion. Maybe you could measure this kind of with that, and that it's really wide, and we might, if anything, might see it kind of snap back.
You see, is this, looking at the S&P 500 here, we could sing a similar tune about stocks outside the US?
Right. Yeah, the stocks outside the US have some other factors going on, but the dollar is a big impact in there. But yeah, I think you're right. I think people have gravitated again back to that idea that the big tech names tend to be the defensive play. You got a war in Europe, you got a big slowing and an even more communist leading China than they were pretending to be before. So you've got a lot of risks outside the United States, and so that defensive tech trade maybe gets the money. But when like the light peeks through the sun peeks through the clouds, ultimately I say valuation is always the most important thing, which is ultimately there's only one thing that matters, and that's profit.
Over time. Yeah, over time.
Yeah,
We know
yeah.
over the next 12 months, it means almost nothing. But beyond that, then
Right.
it actually gets priced appropriately. At least you'd hope at
Agreed.
some point.
It has to. If it isn't, then the market is broken, and I don't believe that. Short term, it
Me
might be.
neither.
Right.
You got a fancy tool that I asked you about. What's the Fed telling you here?
Yeah. Okay. So we're following up Oppenheimer with Barbie here, I guess, right? Like this is just keep your movie themes going. Fed, Fed, right? We've been hearing this for 18 months, if not a little longer. This is a chart that is talking about how the market views the probability of Fed policy, like basically where are rates going to be. And this is looking at how the market views, if you can see at the very, very top, the December 24, so a year and a quarter from now, what does the market think rate policy will be? And what's really interesting here is there's the now, which is highlighted there in the yellow, and then there's the a month ago. And what this is basically showing you is the change in circumstance that last week's Fed meeting brought, or I should say this week's Fed meeting, which is ultimately the idea of high for long. If I look back a month ago on that far right there, you can see that there was probably about a 55 or so percent probability. The market was expecting over a 50% probability that the Fed would have cut rates by a full percent a year from now. So they've been in restrictive territory. They're stepping on the brakes. But hey, we're going to have to ease off because we've cured inflation. The economy is getting tough. Like let's come back down, right? That is now down to only a 25% probability. So why would I point this out? High for long in Fed policy, but more importantly for me, it is absolutely the story of the last 18 months, which is that the Fed is constantly moving the goalposts on what they're telling people rates are going to do.
Yeah.
So that this is what dominates the macro picture, and all the other dominoes kind of trip with Fed policy because it's just the dominant thing right now.
I know. It's fun to talk about macro. Predicting it is close to impossible, so good luck, but an interesting chart to say the least.
Yeah, interesting, right? To add to this is how the market also bets against what the Fed is telling them, right? Which is the Fed in this recent data, they said the median Fed funds rate, a year from now is going to be 5.1%. The market is betting they're off know they're going to have to cut faster. So just what the Fed does with rates is kind of different to how the market bets with rates, even though they should be listening to the Fed because the Fed has been pretty consistent in telling them what they're going to do. But it is the story, moving the goalposts with each, quarter or so.
This was in June of 2021. The summary of economic projections had the Fed funds rate at like 0.1% in June of 2022. And we all know how that ended.
That's right. That's when you get a massive change in circumstances. You get the worst bond market in 50 plus years.
Yeah. Okay. So you have GDP next. Do you think how does this impact GDP or it doesn't? Or is this you here to tell everybody everything's awesome because GDP estimates are pretty rosy?
Yeah, well, this is that question is an interesting one. I think I wrote about it in a letter a little while ago about what do you root for? Do you root for a bad economy so you can get low rates, like crack addiction kind of thing? Or do you root for like a great economy and higher interest rates and hey, everybody keeps their job, but we have to deal with higher interest rates, right? Like, I mean, I'm of the belief you should probably root for the latter, right? A good economy rather than getting these ultra low rates. But and it's a tangled web. Point here is okay, if we had Barbie and we had Oppenheimer, what's my next big picture here? This is my third.
Let's go Tom Cruise, Mission Impossible Dead Reckoning Part 1. Come on.
Oh boy, that sounds like a Brett movie if I've ever heard one.
So good. So good.
Yeah, I will say this is GDP, right? Like Fed funds, we got GDP, we got all these other things, but the PEs, price earnings and ratio. This is in a nutshell why the Fed's hands are tied and why when we looked like we had a nice, easy ride of things, soft landing was the story sort of the first half of the year, even though you had a banking crisis and a debt ceiling fiasco and now a government shutdown. The estimate on third quarter GDP right now sits at about 4.7% growth. They cannot slow the economy. And they're putting the brakes on, and they just can't. And even though the inflation figures are coming down, this is what's tying their hands, right? And like I was joking in the beginning of the year about the Paul Revere, the recession is coming, but it's not. Things, there's these economic indicators slowing and some of these other things, but ultimately the economy is still very, very robust.
It is. And look at unemployment, right? I don't think they ever put out a summary of economic projections that shows unemployment at 12%. If you look at it at the end of 2024, they have it at 4.1%, which is a slight uptick from the 3.8, so to speak. But again, they're just projecting soft landing, which if you're in their seat, I guess that makes sense.
You'd be hopeful. Yeah, I mean, that would be probably best case scenario, right? I always sort of, you heard me share around the office. I've never seen a recession with full employment, right? Like, I mean, I guess COVID would be a weird example where such a massive change in future expectations creates a contraction in growth. But normally people out of work is what slows down growth, right?
Yeah, it will. But so pops in unemployment usually come after lows in unemployment.
Yeah.
Right.
Yeah, they lag. Right. It is lagging. That's true.
So, and again, the market will do it before unemployment does, right? That the leading indicator that it is, but ultimately it'll change. Just the tea leaves don't seem to show that people are having a tough time finding work. That's all. But again, there's also, I think, especially me, right? You're a bit older than I am by a year or two. You remember recessions that aren't the great financial crisis. Right. You don't always have to have a recession where it feels like the world's coming to an end.
Yeah, I mean the recent ones that are real, like the dot-com bubble, Enron, Gulf War, 9/11, all this other stuff. Those tend to be real swift changes in markets. Markets are just more volatile. There's a lot more, technology trading things. But yeah, you can have shallow recessions that are just something that you kind of pass through. But this is the era of the modern Fed, these long economic expansions where they manage things really, really well. this one, they clearly got wrong, but again, it was also a pandemic for the first time in global
I know.
pandemic since the Spanish flu, right?
Okay, so last chart here, another topic that's on everyone's mind is cash. As you talk about rates being high, I think something that everyone may need to come to terms with is you might hold too much cash and not enough stock or bonds. Why would we say that when you're getting paid 5.5% sitting cash right now?
Yep.
That's great. To take a step back, if you're trying to construct a portfolio or even a balance sheet, from our perspective, and we're probably not the only ones that would say this, we put the longer term return of cash at what will pin into the rate of inflation around 2.5% over time,
You're right.
and
Yep.
core bonds 4.5%. Right. So if you're deploying capital as per expected returns, there you have it. Those are expected returns, and we're not making those up, right? Markets dictate that. And then what's this chart telling us? This chart is showing us that over the last 7 hiking cycles, core fixed income has outperformed cash by an average of 14% in the 2 years following the final interest rate increase, and has never underperformed. Hashtag reinvestment rate risk.
Yeah, completely right. I sort of share with people that your 3-month treasury at 5.25, even your 1 year, we're 5.5 these days. The market's moved up. Is because you're locking it in literally for 7 days, or in the case of a 1 year, maybe 1 year. You have to take this. The market is smart. It knows all the forward expectations on rates, just like and it does the math on it. Do you want to lock in 8 years at 4.5, and just bank that, as opposed to 1 year at 5, because that 5 is going to turn in 4 and 3 and then 2.5, and never mind, like you said, the reinvestment risk, that if rates do fall, you'll actually get some price appreciation in owning that longer duration stuff.
Absolutely. There's ballast again. There's actually ballast again. So I strategically, if I'm you meaning the listener, here's how I approach my cash allocation. How much cash do you actually need? Think about it without the 5.5 in mind. Once you determine what you actually need to hold in cash on your balance sheet, then make sure that amount is earning 5.5%, not 0.01%.
Yeah.
That's where the opportunity is, in one humble man's opinion.
Yeah, I mean, there are, if you get really technical, you can sort of barbell the yield curve and these other sort of strategies that
Ladder CDs, go crazy.
talk
Ladder
about
CDs
in the investment community, right? But yeah, these days the people are trying to keep the banking system tries to keep their cost of deposits low, so they don't pay you as much, and you can, and we do this for clients. We go out and try to find the best yields that we can for cash balances that are, not necessarily writing a check on tomorrow.
Yeah. Jones, that was good. Brett's going to be nervous when he gets back.
Oh, I find that hard to believe. I know. Especially because
we'll let the viewers decide.
I critiqued Mission Impossible, which, like that might earn me, the penalty box or something.
Have you seen all the Mission Impossible films?
Thankfully, no. I am an action blockbuster guy, but Mission Impossible just does not speak to me. I can't tell you why. Bourne Legacy, Jason Bourne all day long, but something about it's like the Fast and the Furious. It's just a little too.
Oh my gosh, you just upset.
I know. Brett really
just woke up. What time is it in Paris right now?
That's a major penalty for the penalty box.
His favorite film franchise, you just threw under the bus. Oh my God.
I know.
That's a perfect note to end on. Lane, thank you for filling in.
Yeah, well, thank you for having me, and Brett, come back. I hope I kept your seat warm.
See you. Thank you, Jones.